हाँ नमस्कार नमस्कार प्रिंस जी, आ रही है आवाज जी।
Great, great. So we'll be starting at 5. So Kaushik will be joining shortly, or the session would be more around the forensic investing, which can help us identify the loopholes in the financials and in the fundamentals of a company. So this is going to be the last spaces of this year, and this year has been very really overwhelming. We had so many guests with their maiden spaces as well, and all those podcasts are uploaded over the YouTube channel, which can be revisited at any point in time. So he'll be joining by 5, and surely this session is going to be interesting. Deliberately, the time has been kept as 5 p.m. because it's the last day, and most of us are in party mood. So do not want to spoil that. So I hope this 1 hour session is going to be interesting and add value to everyone around. In case you have any questions around the topic being discussed, please feel free to send in a speaker request, or you can type in the comments also. And if you are yet to follow us, please give us a follow. That is basically an appreciation for our work, which gives us the necessary motivation so as to bring more learned people. So we have Kaushik with us. I'm sending in the speaker request. The voice issue pertains, or you can send in a speaker request in case you're not getting. Kaushik, any issue on your part, or I have sent it again. So if you're not able to, you can do one thing, drop in once and you can rejoin. Okay, I got it from your end, right? Hi, Kaushik. Yeah, loud and clear. Welcome again.
Yeah, thanks. I'm sorry.
Not
I
a
was new for this.
not a problem. So how are you, buddy?
I'm great. How about you?
All good, all good. So, guys,
Yes.
today we have Koushik Mohan with us, and let me take a moment to introduce our guest for today. So, currently, he's a lead analyst at Ashika Group, basically covering mid and small cap space. And as far as his previous work profile is concerned, he's ex portfolio manager and head research at MOAT Financial Services. Prior to that, he was working with Northern Trust, Chicago-based bank that manages more than 1.07 trillion dollar globally, and he has also worked for over 3 years in an audit firm, which has helped him hone his skills in forensic. And basically he is one of the finest forensic analyst, and by education he did his bcom, and he's an mba from nism, that is basically a sebi registered institute, and he's also a visiting faculty at bsc. So welcome again, Kaushik, and would appreciate if you tell our attendees what they can expect from today's session.
Thanks, Prince, for inviting me here. I'll just give myself a small introduction. I started my career and started investing in markets since 2013. So when I started investing in those kind of companies which are very near to me. I'm basically from Bangalore. So there were like a lot of industries near me. If you go for Hosur, I used to find Titan. I used to find Gemini Autos. I used to find Suprijit Engineering. There were a lot of small scale industries, but when I was in my family, one of my family member was working at Gemini Autos. So he told me about the company. He told about how the company is helping their employees and how the manufacturing unit works, how their products work and all. So that's how I was like fascinated, and I asked my grandfather some money, and I went and invested in that company. So after investing there, I was sitting there for an year, but I didn't make any money from there, and I lost a lot of my money. And second company which I invested was PI Industries. PI Industries came to me on luck. So I heard about this company from one of my friend. He told me that PI industry is in agrochem, and simultaneously they are supplying it to US. So as a small person, like I didn't understand what he was trying to tell me or like anything. I went to my grandfather and asked him like, "Do you know about this company?" He told that we use this same company's products in our farm. So I was like, "Okay, that means that we are using it. Let me try and invest." I went and invested a small amount in that company, and that every year I was looking at their sales, it was growing or not. Because as coming from a family background with business experience, I was like fascinated to see the sales and profits. But I never thought cash flows would be more important. What I missed on Gemini Autos were cash flows more than profit and sales. And but what I didn't miss on PI Industries is their sales, cash flows plus their profit and loss account. So this three statement, understanding this three, how the number is flowing for each account to another account and how they get tallied and all, that made me more fascinated towards accounting side. Then I thought I'll become a CA, and because in that age, like a lot of my friends were like going for let's become CA, like let's start doing IPCCA, because like CPT, we gave CPT, and then I joined for IPCC. That time only one of my dad's friend told me that join our office, like you can work here for 3 years so that you'll get your articleship done. So I went and started working with him. Around 6 months I worked over there in his office, and he told me that okay, Kaushik, if you wanted to work on big companies or listed companies, then he recommended to me and to his friend. That's where I went and I started looking at listed companies financial statements. By doing that, I started understanding some kind of journal entries and how numbers were flowing from one account to another account. And there were also some times that I used to find that why it is not matching, and then we used to call it something called as miscellaneous accounts. uh, we used to tie up every number into that miscellaneous account, and we used to see the accounts and give our approvals. Then in that 3 years, I was able to understand how numbers flows to one account to another account. What actually numbers speak to a person. What I think about investing is all about numbers are something like your girlfriend. Once she start talking to you, right, it keeps on talking to you. It will not stop at all. But for that, getting that spark from her or like towards you, the attraction towards you, it only takes time for you to give her the time. So after that, you have everything in your hand. That's where I started looking at numbers. And then I joined Northern Trust. I was an OTC derived trader. So I thought I can do a lot of trading and I can make my money for self and do things. But to be honest, I only lost my money in trading career. Then I joined MOAT Financials. It's a PMS company. So here I started as an intern. Within 2 months, they confirmed my job, and I was like very happy. After confirming my job, I worked under very big veterans in the market. The person who I was working with, his name was Suraj Nair. He was the person who was the founding member of Equity Intelligence with Puranju Vilayat. So from there, I started understanding how small and mid caps work, and what are the different kind of paperworks work on, and where and all you can see the opportunities. And what the major thing what I learned from him was the capex stories. Whenever the company is putting capex, and if that is getting converted into asset terms for the sales, right? That's how the sales number will go up, how profits will go up, and cash flows will go up. That's an mega trend that you can play it on for making money in markets. So I started working with him and learned a lot of things in moat. And I myself climbed the ladder from all the way from an intern to be a fund manager at the Moat PMS. And then in 2021, 22, sorry, 2022, 21, I was awarded as the best fund manager from Business Today. And I was been given the honor, like performed 1 year duration. I got an star rating of 5. After that, in 2020, one December, I thought of let me launch a fund from my own side. Then I spoke to Moat, and we got an very good response. And then again, we went on to meet one distributor that we know in Gujarat. We met them, and then we started a company called as UpperCrust Wealth. In UpperCrust Wealth, the most important philosophy what we look at was number one rule, that is capital protection is more important. Number two rule is the capital protection is taken care, the capital growth will automatically happen. That was the philosophy that we had, and that's how we floated. And there, for me to launch a fund from zero level to understand the fund and managing fund, this experience taught me a lot of things. And then there were some things happening, and in September I was supposed to leave the organization because I wanted to come back to my home because of some personal reasons. Then I was in September, then I got another opportunity in Mumbai, where I joined Ashika as a lead analyst for their mid and small cap division. Now I'm leading a team of 4 people over there. This is my background.
That was quite interesting. So directly coming to the framework. So you touched upon many pointers, but again, if I were to ask you, what is exactly your investing framework and how it has evolved over a period of time? You started off in 2013, right? So there are
Yes.
9 odd years. So there must be some phases which you already talked about. But again, what is core to your investing?
So the real core to my investing is that looking at numbers, how numbers flow from each one account to another account. If that numbers are not flowing properly, then there will be some or the other place that the number should get stuck up. So I learned this within a hard way, where my to be very honest, Suraj was very friendly with me, and he gave his personal money around 50 lakhs to me. And I'll be very honest, I lost that money in entire 1 year. So I was like trying to understand how numbers flow, but I thought, okay, I worked with an auditor, I worked with a lot of people, I understand a lot of things, and I can make money from the market. Uh, that was the duration where I thought lot of expectations were there with me, but I lost everything. Luckily, like he calmed down me by telling that it's part of the life, and you have to take it up. And then the phase for then again around 4 to 5 months, I was just sitting idle in my company just to understand what the philosophy that I need to follow so that the things will work out for me. At that time, I used to track the companies like metal. I used to track around infra companies. I used to track telecom companies. I used to think telecom will be the big wave because Reliance coming into existence, and Bharti Airtel and Vodafone. I was thinking like if Bharti and Vodafone merge, Idea, Vodafone and Bharti merge, then Reliance will be like a small player. That was my thought process at those days. But I was totally wrong over there. I was looking at how mergers happens, how demergers happened, how spin-off of the companies happened. But everywhere I used to lose my money. Only one place that I used to make my money was how asset turns work out. And the more concentration that I started focusing on only one number called as return on equity. I would ask why till that time that how this return on equity is coming like 15 or 20 percentage, because return on equity is something, a number which is having, it's a dew point analysis. It is constructed by three numbers: net profit margins, asset turns, and financial leverage. So I used to like companies who are working on asset turns more than net profit on financial leverage. Even in asset turns, I used to like those kind of companies whose asset turns were coming driven by working capital asset turns more than fixed asset turns. I used to like working capital asset turns because strong working capital control on is place. That means that the competition cannot enter into the game. And first company which worked out for me, and from the IPO we hold it, that was demand. So the entire demand numbers flowed, and the entire return ratios worked for demand was only from working capital turnovers. And that's how the sales was flowing, that was the payments were made, and that's how the controlling of cash flow happened. And the company, we know how DMart is now currently. And that became a very big riding for me. And second company that became very big riding for me was PI Industries. It actually took over all my entire portfolio. Around 40% in my personal portfolio, around 40% my money has been in PI Industries. And happy because I made money, and also not happy because I lost a lot of money also. So by this framework and things, I was able to understand what things are going on.
So Kaushik, like any screeners or any ways to generate idea before directly jumping into checking numbers is not possible, right? So how you go about it, and
Okay.
what are the
Yes, yes.
sectors currently you are bullish about?
Okay. So what I do basically for any company that I wanted to invest, the first and first filter that I put it on my screen is that the market cap should be greater than 500 crores, because I don't want to play with that below 500 crores market cap. Companies might fall into liquidity traps, and the error that I can make it on those kind of companies will be very high. The probability of losses will be very high, because I'll be investing not only my own money, I'll also be investing my clients' money over there. So that's where the first filter framework came into my existence. The second filter, what I was looking at, cash flow from operations divided by EBITDA. This number should be somewhat around 70% for me. 70% is something that I would be comfortable for past 5 years. If there is no cash flows only in the company, that means that I'm trying to find, I understand the business, I understand the management, but the cash flows are not there, return ratios are not there, but the potential for these things to happen positive in future is very high. That's where I find multi-baggers. But finding multi-baggers and investing in them, the probability will be like, if I'm investing in 100 companies, one company might be a multi-bagger like that. But 99 companies that I have to look at, I would be looking at somewhere around cash flow should be greater than 70 percentage. And the third ratio, which is very very more important for my life and it saved my entire life, is that cash tax divided by income tax. This ratio should be greater than 60 percentage. So let me put out here, there are in India we have around 4,800 plus companies listed. In 4,800 companies, if you take cumulative cash tax for last 10 years or last 20 years, if you take the cash flows, the taxes that you pay for the government, divided by the income tax entry that is there in the P&L statement. If you do just this cumulative number ratio, right? Uh, any guess anyone wanted to take over here? How many companies that filter in our Indian markets? Prince, would you like to take an chance?
Kaushik, no idea. If you were to give some options, so I might
Uh,
choose randomly, but
so it's around 28 percentage of companies only filter in this ratio. That means only 28% of companies whose cash flow tax paid to the government is greater than 70 percentage, that they put it on their P&L statement. That is thus income tax expense or tax expenses in their P&L. So this ratio helped me to detect lot of companies that who are doing like who are randomly coming and telling, giving big promises, but nothing works out for them. I was able to eliminate those kind of companies. I was able to find good companies that I can be invested. The probability for me to be invested and make money went higher with this ratio. And second and the fourth filter, what I put was on employees. Let me give an example. We know India's biggest bank. Prince, can you name any India's biggest bank?
HDFC,
HDFC. It's in private sector. How about in corporate sector?
SBI, SBI,
uh,
SBI.
uh, 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 it is SBI, right? Tell me the average employee expenses is there, right? Which company would actually pay more salaries to its employees? Is it HDFC or Kotak or SBI?
It must be SBI.
Y- Yes, you are right. SBI is actually the growth in employees cost is around 20 percentage. But when it comes to ICICI or Kotak or HDFC, the employee cost is on average around 7% growth. And you know, like what SBI's average number is? It's actually 15 lakhs per annum on an average. If you take total employee cost divided by number of employees, you'll get 15 lakhs per employee. When you do the same number for other banks around like Kotak or HDFC or other banks, you'll get this number to be around 7 lakh or 6 lakh. This is totally happening because of the competition coming, and because the private sector banks are so much competitive in nature. They wanted to get the highest benefit out of the lowest capital that they can put in. So that's where I understand the capital efficiencies in the company. I remember one of the example in 2021. I was searching on some company. It was a consumer tech company. This consumer tech company's IPO was oversubscribed. Uh, Even institutional side also it was oversubscribed. Company's employee cost, average employee cost was just 2 lakhs in 2021, and before that year it was 2.5 lakh, and the top level management salary is 25 lakh, and they claim that they have an employees of in top level management 8 people are from IIM, and I am Bangalore, Ahmedabad, and I think another. I'm forgetting the third IIM that they have it. These are the people, and their employee cost is around 25 lakh. I don't know who's going to pay around 14 lakh, 25 lakh for an IIM candidate. So normal IIM average salary packages are more than 30 lakhs for this top three, if you say ABC. And this company's average salaries is around 2 lakh in 2021 and 2 lakh 15 2020. So this company came into IPO and they got oversubscribed, but numbers were very, very fishy. So employees side, if you do more analysis, right, you will understand what is actually happening. And also you can in this era, we are having a lot of social media in ourselves, and like we have Twitter, we have LinkedIn, and we have other spaces where we can actually reach out to the employee of that company and actually talk to that employee and get the validity of the data that you need to get it from that employee. So if you're investing in any company, just talk to the employees of that company. You'll get better, the highest probability of data to be very precise only from employee. So talk to ex-employees, talk to the current employees, and talk to the people who are recently joined the organization. These are the three people that you need to talk to get a lot of your understanding on the company. So these three filtration ratios will land up to me around 200 to 300 companies. And in this 200, 300 companies, what I do is another ratio that I put it. I need return ratios or expected return ratios to be very high, to the north of 20 plus. And I need the valuations to, I follow growth style of investing. I call it myself as value growth oriented investor. So what I do, I need high growth potential companies with large capex coming into, with a very big sector that they are entering, and they wanted to be in a very specialized product in themselves. So if these things are in my favor, that kind of companies I start working on. Because in India, like we know, like now money is not infinite or time is not infinite. It's very, very finite. So we can only work for very less companies. And if you're working on those companies, just give your wholeheartedly work on them and get your numbers right. And then think how the story will look out to you. So if you're investing, you cannot see more than 3 years or 5 years. People might even, like in sell side, or like you can see on other KPO organizations, like what they do in their modeling. We just put our entire emphasis on the terminal value. And if we are doing DCF, and the majority of our valuation comes from the terminal value, 60 to 70% of our present value is dependent on terminal value, whatever the growth is there or whatever the numbers are happening. So if you're doing that right, you might fall into trap. So you cannot see more than 3 years. Even the management of current management only cannot see around 3-4 years of forward. So you should be very conservative in yourself, and then look at what is happening in next 3 years. Is it forward looking, you are able to make money? Then that's the place you need to be staying. And also I look for more onto earnings growth is the place that I would love to be. If I can see, if the current earnings is 100 rupees earnings per share, EPS, and if that 100 rupees can go to 200 rupees in next 3 years, I would love to stay in that kind of companies, but at a favorable valuation. What is favorable valuations? Valuation is only driven by 2-3 numbers. One, it's return on capital employed. Second one is growth, and third one is the great management. If you don't have these three in your favor, right, your valuations, whatever you do, will be into losses. So you need to have great management, because he should actually share his profits with minority shareholders, because that's the guy who's running the show. And you need to have return ratios in very good favorable number, because if return ratios are not under favorable numbers, if you have high growth, growth is there but return ratios are not in favorable, that means you have to dilute the existing equity or you have to take debt to run the show. So if you're doing that, keep on doing that for a longer time, right, that you might get into a trap. So you have to be very careful in this kind of valuations.
Great pointers. So Kaushik, I have like the third point which you told us is like cash tax is to income tax ratio. So could you please
Yes.
come again? What is the significance? I didn't get it. And one more thing, like you talked about the employee cost, right? So what
Yes.
about the companies who are into say the R&D units are bigger and they have more spends on R&D, or maybe they are in initial say the pharma companies in that
Got it.
sector, the per employee cost ought to be higher, right? So
Yes.
if those pockets got eliminated, so how you go about it? These are my 2 points which you would
Got
like
it.
to, yeah.
The Let me take the first point. See, cash tax. What is actually cash tax? Cash tax is an expense that you actually pay for the government. Or let me put it in simple understanding. If you ask for me, do I pay tax? Yes, I do pay taxes. What do I do? I calculate for myself a tax that what will be there, and I expect this much taxes will be there. That will be an P&L statement expenses, and what I actually pay to the government will be actually that cash outflow. It will be a negative number to the from my hand to government. This cash tax will be a numerator, divided by denominator will be the tax expense that I claim. For this much profits I need to pay this much taxes. Think you made around PBT around 100 rupees and your tax rate is around 26 percentage. That means that your tax expenses for that year according to P&L statement is 26 rupees, but you actually paid government only 20 rupees. What is 20 divided by 26? It's around for me to be on a proper note, let me take it as 30 rupees. Tax rate is 30 rupees on your denominator, divided by 20, where you paid around two-third of your money. That means that two-third of money that you actually paid and one-third of money is still with you that you might pay tomorrow. It called as like deferred tax asset or deferred tax liability. But deferred tax asset or deferred tax liability cannot stay for longer duration. You have to do this ratio for longer duration, around a cumulative number of 10 years or 15 years, or if it is possible from the existence you can take it. You can also see that the benefit of 5 years when you are starting your own company, you get in tax exemptions. So you can actually see that and all. So almost around, if you don't pay government around 70 percentage or 60 percentage that you promise, then that means that the company is not having the actual profits. If company is not having actual profits, right, in P&L they might look like profit is like 100 crores or like 200 crores, and taxes they're telling like around 30 crores or 60 crores that they're paying. But if you don't see that are being paid to the government, that means that whatever the profits that they're claiming in P&L are a fake numbers. And
Got it.
what is your second question?
Second question was on the employee cost, that R&D spend or that kind of companies
Yes,
which are more.
yes, 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 yes. So, see, when it was like an R&D side, your number of employees also will be very low, right? R&D will not happen with 200 employees. It will happen with only 110 employees, right? If it is with 10 employees, the cost per employee will be very high if you are doing R&D. It will not be the lowest number. You'll have lot of employees, and per employee you're only giving an employee cost of 2 lakhs or 3 lakhs. And you're telling you're a consumer tech company. This is like I'm giving a exact example. It's a consumer tech company which recently in 2021 which got listed with around very high. Matlab, people were pagal behind that company to be invested. That kind of company. This company's employee cost, average cost per employee was 2 lakhs. And unbelievable. Tell me, and their office is there in like metropolitan cities. And the cost of living in metropolitan city, an engineering graduate at least minimum gets 6 lakhs. So if you would have got 6 lakhs as an average employee cost, right, then you could have thought of that company, okay, they're doing something really great. And the employee cost is very low. So if you see this kind of abnormal way of numbers, then you have to be far from that kind of companies.
Look, Kaushik, like coming to asset light sectors like IT, in which the employee cost is the only main cost. Uh,
Yes,
mm,
yes.
so how you take those companies while evaluating? I mean, what do you keep in mind, and basically this employee cost thing?
So when I'm investing in an IT kind of companies, I would look at what is the top level management and who are actually running the business. Are they actually having the sales experience in this IT business? Because majority of Indian IT business is a commodity business that we need everyone need to be agreeing upon, because we in Indian IT sector is actually biggest price war that you can read. The second biggest price war that you can read is from paint sector now currently, and third biggest is you can read it from diagnostic sector. But the first one in India, it is every time an IT sector. So when you know it is like a price war event, and if you don't know what top level management, how they're connected, well connected to the industry, how are they getting the orders, if that you cannot analyze that side of the point of IT sector, then the probability of making losses will be very high. And but if you are able to find out the other side of the space, you will be able to understand where and all the management can go and get you the orders, and that the employees in India are very cheap, because in US, if you do the same work in US and if you do the same work in India, right, the cost will be very very different. So you will actually around save around 6 to 7% cost if you're actually doing the work from India. So that's the reason, like Monish Pobre, we all know he's a very great big investor and greatest investors that we are in the current scenario. That he himself was running an IT sector where he was outsourcing his entire work from Delhi, from India. He used to get work from Delhi and Bangalore, and then he used to sell, and he used to run this kind of business. So we need to understand the top level management. The second thing, what is the average cost? Is that average cost justifying for that kind of metropolitan city? Wherever, for example, the location for that company is in Bangalore, and if you can go for Bangalore, and you can ask around yourself and or your lot of friends who are in IT sector, what is your average salary, or like what is the salaries that you will get, and you can take an average of that, and you can see that is this IT company is actually paying that average number or not. If that is paying, that means that whatever the company is telling is actually true.
Fair enough, Kaushik. And it is very intriguing, which you talked about the mega trend, the Capex thing, conversion to asset turns, right? So,
Yes,
would you
yes.
like to elaborate more on that, and any example which you would like to cite?
Sure, sure. So, let me be very frank over here. Like, only the money that I made in industry is only from the mega trend, which I call it as a mega trend of asset turns. If asset turns is happening, and asset turns is happening through a working capital and fixed asset turnover, I'm happy to put my money over there. So, let me put an example over here. Like, what is return on equity? Return on equity is driven by three numbers. One is net profit margins, second one is asset turns, and third one is financial leverage. Let's ignore financial leverage because we don't want to play our entire game with that. So let's think that financial leverage is one. That means equity and debt is like equal. So we are one. And when it comes to net profit, if you are having higher net profit, right, like paint sector, if you have high net profit, people from other sectors are more motivated to come into your sector and take that net profits in their hands. That is what happened. JSW or like even Birla or like the other player, whoever came into paint industry, by seeing the 7,000 crores of profits that Asian Paints used to make. If paint industry is making that such a kind of big profits, right, people are more attracted. If think like profit as like honey. If honey is open with a jar of honey is open with a cap, the bees will start attracted towards it. So you'll end up making that profits to everyone. You'll not There will not be like only one person will be making. So how can you compete with the entire world? That's the only one way. You make your profits in such a low level that other person will not at also look at your business to come and enter into a. You will not at all be ready to do the business by seeing your profit margins. So the second thing what you can do is that Now, where you can drive your return ratios, you can only drive by economies of scale, and that is asset turns. Make sure your asset turns is in such a level that you are utilizing, you're sweating your assets in such a level that you can make better and better sales out of it. Like that's what DMAT does. And currently, the one of the companies that I am very bullish on, PG Electroplast, they are like sweating their assets every day and night. They are so PG Electroplast in AC consumer durables. They produce AC, manufacture ACs, manufacture washing machines, and etc. These guys, they literally started working on their belt. If you see any manufacturing unit in their plant, if you can see it on YouTube or anywhere, you will see there will be a belt where the ACs or like molding, everything will be going passing on. They'll do a lot of R&D on that molding thing, and they started producing from the same belt. Previously, they were able to produce 100. Now they're able to produce 120. That means that with the same assets, they're able to generate better utilization of an asset. That's how Relaxo did it. Relaxo चप्पल तो कितने में आता है? Like we know Relaxo's average price is only 300 rupees. It's actually lower than that. Even like 170 पे भी मिलता है. But 300, the flight, which was very much famous, बहुत famous हो गया था flight, that was available at 300 rupees, right? Their profit margins was only 4% or 3%. No other player was happy to enter into. If in this kind of this thing, right, you will be able to become big. But till becoming big, right, you are putting a lot of capital back into the business. So this kind of investing style works out to be the favorable way to make money.
Great, great. So guys, the names taken during the conversation are purely for example purposes. Please take that as a starting point. Do not act on the buy sell of any of the names. Right? Our spaces is purely educational. So Kaushik, like, does this company, the which you named recently, it works on the model of Dixon, or it's like how?
It's same like Dixon. Yes, it is same like Dixon.
Okay, okay. So Kaushik, coming to valuation thing, how, I mean, is there any capping to the valuation multiples which you give to the company, or that depends which company you are looking, and basically sector or maybe anything, any criterias for as such, and also how you identify whether it's a value buy or a value trap?
Okay. So I don't believe on value buy or value trap. Majorly what I do is like if I can find higher growth, right? The growth will take care about the value what the company is having in its favor. So I would look at am I getting at a good growth levels? Is like is my growth greater than my return ratios? Or greater than ROE or ROC, I'll be allowed to be invested there. So what happens in this place? Yes, they might dilute that kind. That is on theoretical side. What I do for calculating return ratio also there is something different. What is the ratio for return on capital employed? It is called EBIT divided by total capital invested. What is total capital invested? That might be debt and plus equity. So in P&L statement can be manipulated, right? But the cash flow statement cannot be manipulated. On a longer run, cash flows never can be manipulated. So what you can do, take the proxy, the CFO cash flow from operations will be equivalent to EBITDA, EBITDA. So what you do, cash flow from operations minus depreciation amortization, you will get EBIT, CFO ka EBIT. Just take that EBIT and divide by total capital that is invested. So if you can find this number, it will be like somewhere around 15 to 20 percentage. That means you'll be very sure that your company is actually making returns greater than cost of capital. Because Hindustan ka cost of capital is somewhere around inflation rate is 7% and 10-year government bond is around 7%. Total to 14% ho gaya. And in India, if that company is making greater than 15 or like 14, that means that company is actually making money for himself. And there will come efficiencies also. Whenever if you do single side company, one side company, you can go and see that what is the debt that the company has taken, and what is the, if you see the debt schedule, right, in the below point with a star mark, they will give that what is the cost that they are incurring with that debt. So you can actually calculate the weighted average debt cost plus equity side, easily assume that around 15% will what be the equity cost for the company. So add it up, weighted average cost of capital, you'll get it. And if you can again see, this weighted average cost of capital is somewhere around 12 or 14, and your company is making cash return on capital employed divided by is greater than working weighted average cost of capital. That means that your company is actually making some returns for your table, and that is being shared with the minority investors. So how it will be shared with minority investors? Make sure that the management is great and he is friendly to share it or not. Is he paying dividends? Is he paying is he, if he is not paying dividends, is he actually investing in the same business, or is he investing in different business? If he is investing in a different business, then ask him the question in the con call, why are you doing that? If that industry, and if you're satisfied with the growth opportunity and everything, then you can take into consideration. If that is not happening with the growth side, it is only like to acquire someone, like like Satyam was trying to acquire Mythos, and that's where he got caught. So if that kind of entries are happening, then be away from that kind of company. If that is not happening, then you are on a favorable side. And now you try to calculate growth. How do you calculate growth? Look at the industry size. If industry is somewhere around currently one of the companies that I'm very bullish on, it's into it's making paracetamol ka main drug. It's called PAP, paracetamol. Paracetamol industry in India is somewhere around 1,20,000 crores. Majority of our PAP is being imported from China, and Chinese rates is around 554 rupees per kg. And this company, which works in India, is actually making a aminophenols at a price of at a price of 512 rupees. He's making PAP at a better prices, and he's able to sell the PAP at 515 rupees for the Indian people. And this guy is actually, why he is able to do this at this scale, or at these prices? Because he did an R&D, and he was collaborated with one of the scientists, and then he found a way that the process can be made in one step process, which was on nitrobenzene route. But other people or Chinese and all, they were doing it in a different 4-stage process in a different route. This person was able to make it in one step process, and also not only in one step. Now that company came up and told in their this one, the disclosure what they give it to SEBI, that they are able to do this entire factory in a continuation production. Previously, it was able to produce around 21 hours used to take for nitrobenzene to be converted into PAP, and same company is now able to do that nitrobenzene to PAP at 10 hours, 10 to 11 hours. So the asset is been made into such an efficient level. The company is able to do this in a lesser time duration. That means that you can produce from the same asset, you can produce more. This one, and the company's promoter, if you look at him, you have to see the promoter is able to actually get sales for the company. If that is sticking for you, right, then go ahead. And if you can find a growth to be around greater than your return ratios, just ignore that. Growth is high. You know that in 3 years or 4 years, you can double your earnings can be doubled in this company, and doesn't matter of what piece or like everything it has been available at. You can just be go and investor there. You'll still make money.
Great, great. And our attendees must be enjoying this wonderful, insightful conversation. So please, you can reciprocate by following our guest for today. And if you're liking our spaces, you can also follow me. So Kaushik, coming to like, what is the recipe of multi-baggers? Obviously, superior ROC, which is sustainable, is one. What other
Uh,
pointers you think are needed?
Superior ROC, expected superior ROC. If you have that, then yes. Expected growth is very high. Yes. If you think that currently the company is making net profits into zero levels, and you expect that the company's net profits will be converted into positive numbers. If you have 2, 3, 4, 5 triggers, right, like this, then only you can actually get a multi-bagger. Or if you want a consistent company, you make sure that if all 4 triggers are actually existing in the company, and make sure that you're buying it in an times like COVID, or like you're buying it them under some kind of bad event, something happened in that kind of industry or a sector, or like even external economic event, then you have to buy them, and this four triggers working currently for them, then you can buy it and like you can make returns. So that's the only way that you can get this one, or else you have to compromise on the triggers, and your expectation triggers is what is very high, then you can be invested and you can make money. So today,
Great.
if you go and invest in DMart, you will not be able to make money because its valuation is very, very high. So if you want to make money from DMart, you have to wait for a period like COVID to make money. You cannot buy anything at any prices. That's all stupidity people talk about.
Fair enough. So, Kaushik, like I read one tweet, and even where we discussed same with Jivan sir also. So, you have some conception on volatility, volatility in price or volatility in earnings. How we should read it?
So what I believe is that volatility in earnings is more riskier than volatility in price. Volatility's price is like driven by a lot of things. Economic event also can affect the price, like Ukraine war, and non company which is not at all related to Ukraine war, and sales are growing, everything is growing, but still the price came down. That is like volatility in price, right? That is not at all needed to be there. It's just an opportunity for you to buy. That's all. So volatility in earnings is more riskier than volatility in price.
Right, fair enough. So, how exactly you screen management? What are the pointers you look for, and what are the big red flags on the basis of which you say that
Okay.
this company or that
Let
company is
me
not investable?
Okay, let me give on a management side one example. I'll not be able to take the name of the management over here. This is a Nifty 50 company. They are like from Pune. Very big management, very well known management. They're I'm telling Pune, it's like Maharashtra. They're very big management. They're like Nifty 50 company, Nifty 100 companies for sure. These companies management has taken a loan from a subsidiary company, 100% owned subsidiary of that XYZ company's 100% subsidiary. Management has taken a loan at an interest rate of 12%. Okay, for his personal purpose, and that subsidiary company has taken a loan from the main group company, the same amount with an same percentage, like around 12%. And this subsidiary company, what is doing, right? The management of this main company is actually paying the only the principal amount, whatever is taken, but is not paying the interest payment to the company. Every time there will be an interest things coming in, they will just extend the duration of the loan. That's what they're doing, and they'll write off every time. This is happening from past 7-8 years for this company. But the subsidiary company is actually not only paying its total interest, he's also paying his principal amount. Interest plus principal is being paid. So what is happening? The management is siphoning off the interest payment. He's taking out the interest payment for himself. So he's like fooling around the minority shareholders by not paying interest. So if you find this kind of companies, right, like let try to be far away from them. And let me take another example where management has done this. Like there is a company whose top level management has taken a loan from the main company, and that loan has taken promoter has taken the loan from the main company listed entity, and that promoter is invested that money into a personal entity of his own personal entity, and that personal entity is buying equity shares of this main company. You're getting the listed companies equity is being bought by the unlisted entities of promoters, and by that indirectly the debt is being converted into an equity portion of that promoter in this entity, and he's increasing his percentage holding in the company. If these things are happening, yes, this is again bad thing, but still it is happening that he's confident that this company is going to do something very big, and promoter holding is increasing just because in a different route. Same profit from the same company which was supposed to given to a minority shareholder, that has been taken by the management and bought back the equity in the company. So if this thing is happening, yeah, ask this to the management. If you're very happy with whatever the answers you're getting, then you can be invested. So that's how numbers tell you about what is the management. And how numbers, it will not be told by 1 year or 2 year 3 year analysis. It will be told in a duration of lot of like 10, 15, 20 years analysis. You will be understanding what management is actually doing. There is another company which I can take. It is from South India, from Tamil Nadu, Coimbatore company. This management, what he is doing, he is actually building an hostel for women employees. That is, it's available in their, matlab, whoever people are there in their factory, right? He's building an hostel, and he's now till date it was running around two shift per like per day. Now he's increasing the shift to three shift, and only 2 hours will be like shutdown of the company. So in 24 hours, 22 hours, the company will be running. Previously, it was running for 16 hours. Now it will be running for 22 hours. So with the same asset, again, the utilization went up by doing small work. Again, the management is like so kind that he is building the entire house and is giving it to their employees. That's very good. So that's how you'll be able to understand what management is about.
Great. If I'm not mistaken, it's from the textile sector, right?
Yes, you are right.
Okay, got it. So great. So coming to portfolio creation strategy and how you manage risk in that. So how you go about it, and what should be an ideal way to go about it?
Okay. Uh, how to manage risk on the portfolio level? The highest conviction, let it be the highest portfolio allocation. The lowest conviction, let it be the lowest portfolio in the this one. If you find higher risk, lower return, then give lower allocation in your portfolio. If you find the highest risk with higher return, then you give medium level of allocation. If you find highest return, lowest risk, you give the highest allocation in your portfolio. That's how you have to maintain your portfolio, and like that's how you have to build your entire portfolio thesis. And then again, it matters with time to time the investor is coming to you. There might be XYZ investor coming at a time beginning of the year, and he got a good entry points in one kind of companies. But the ABC investor coming at the end of the year, but he will not be able to find the same thing. So you have to calibrate at the time that the people are coming, and then you have to work like a boutique firm. Like if it's your personal money also, that if time that money comes into the investment matters than the like buy it at any price, or like buy it the same company, buy it at any time. It doesn't work out like that. Time actually matters, but I'm not telling you to time the market. I'm actually telling you to wait and look at the things. If it is your thesis is before 1 week and after 1 week or after 1 year is still same, then go and invest. If it
So
is not
Kaushik,
same,
like
be very careful.
initially when people have very limited capital, right? They if the situation is like they cannot do much lump sum investing, or they are not well versed with the nitty-gritties of this market. So how you suggest they should go about it? How they can build a base of say capital so that they can play big?
So what I believe, if someone is having very low capital, right, don't invest in more than 2 3 companies. If it is possible, be very concentrated. When you are doing 100% work on one or two companies, it's a very small capital. That means that you are starting your investment career, and you're not investing your entire retirement money, right? You're just starting with small money. Then go with one or two companies. Learn the things. When you see, everyone in the market have to pay the tuition fee for the markets. They have to make losses, then only they will make profits. That's what I believe. So you have to make losses, you have to pay tuition fees. ज्ञान तो फ्री में नहीं आता है. So
But
when
again,
you're yes,
again,
go.
Kaushik, like if it's like initially if we are too concentrated and initially we burn our fingers, in that case we become reluctant to keep in market for long, right? So
That's
at time,
true.
at,
That's
okay,
true. That is true, but it depends on the person who is like thinking about it also, right? Like there might be a situation that i- for example, for my own case, I invested in German autos. I lost my money in German autos. Yes, totally 100% loss. Matlab, whatever I was like doing average up every time, there was a day that total in 2013 1 lakh was very big amount for me, to be very honest. And my grandfather is actually an investor. Like he got my mom married with the shares that he sold it for one of the companies that he was holding. That was a dowry that he paid it. Like I'm accepting. So when you're looking at the first time, right, when you're entering the market, you will lose money. That is for sure. But if you give up, then that's your call. If you're not giving up, then you're learning something, and then you can get into success. The failure is the only way to claim the success.
Fair enough. Fair enough. So, Kaushik, do technicals find any place in your investing? And coming to sell strategy, how exactly you go about selling your positions?
So technicals, yes, I tried myself. I burned my hands in Northern Trust for 1 year, where I was in OTC derivative trader. I was into swaps basically, playing with Goldman Sachs or like BNP Paribas, or like they were my clients. To be honest, I tried a lot of technical indicators and a lot of things that didn't work for me. But what worked for me in the longer run, I look at 52-week week high and low, one thing, and second thing that I look at 200-day moving average and 50-day moving average in a longer run. So if I find some companies are like where the entry points, whatever I'm doing, or like exit points, it's like moving above this average numbers. It should be where this you can use it only when you are entered into a company with four triggers in your favor. You have price in your favor, you have return ratios in your favor, management in your favor, and also growth in your favor. That means that all four triggers are currently happening for the company. There only you can look at technicals, but you cannot look at technicals where multiple triggers are like off. Only two triggers are on and two triggers are off. In that kind of situations, you cannot look at technicals. And technicals will never work on that places, because the price like 52-week average and all will like never talk to you, because those are like following the standard deviation or mean. They are like 95% confidence level. They're like war. They don't talk about future, right? So that's the reason. Like if you're working on four triggers, then you can look at technicals. If you're working on two or one trigger, don't look at technicals. Not even with three triggers. If four triggers are in your favor, then only look at technicals.
Right. And what about the sell strategy?
What I look at as a sell side is like very simple. When I think my growth of earnings is way less than the return ratio, if the growth is like only 5% and return ratio is like 50%, and company is not still paying any dividends, or like it's just piling up that money in like mutual fund. I'm again talking about an FT 100 company only. These guys are like piling up their balance sheet with this big investments, but they are not actually giving back to the investors. So that is like killing the capital efficiency for the investor, minority investor. Minority investor is not getting a chance to do his own capital allocation. The company is taking minority investors standpoint, and he's doing his capital allocation. So if that kind of things are happening, yeah, that's where I'll start exiting.
Right, right. So coming to cyclicals and structural stories, so do you invest in cyclicals, and how macros play a role in your investing?
So cyclical in sense, there is nothing called as cyclical or structural for me. What I look as like, is any sector that I'm entering, is this sector going to be in live for next 10 years, 15 years? Is this something, a trend that is going to happen for next 10 years or 15 years? Insurance is a trend. Yes, we're very low penetrated. But again, let me tell you, like insurance penetration in India is somewhere around 4% or 5%. I think even 7% somewhere. I'm missing the data. It's below 7%, that's for sure. And in insurance, it is 7%. Okay. But let me tell you, what is the population of India? Indian population is around 1.4 trillion, right? 1.1 lakh, 1.4 crores. In this, how many average households are like 30 lakh households are there. If you take per family around five people average, it's around 30 lakh households is there. In 30 lakh household, what is the household income? If it household income is greater than 6 lakhs, just look at household income greater than 2 lakh, greater than 6 lakhs, greater than 10 lakhs, and greater than 50 lakhs household income. Like with that, you can see the data that Indian household income, majority of household income, who's greater than 6 lakh is only 20%, 28 or 29% of Indian population household is greater than 6 lakh household income. Below 6 lakh is majority. In majority below 6 lakh, that means that what again you can see that in below 6 lakh, what is the household average household? That used to come around 2.5 lakh. 2.5 lakh. How to calculate this 2.5 lakh? What is the per capita income in India? It is $2,000. $2,000 into five people, it is $10,000. $10,000 you convert into Indian rupee, you will get 2.5 lakh per year. So this 2.5 lakh per year, Do you think these people can buy insurance? No, they cannot buy insurance. So they are eliminated from the entire population that set you're taking. Only with 28% of population households, right? You have to see what is the penetration level. Then you will understand that this penetration is lower penetration or higher penetration, or is a structural trend for next 10 years or 15 years. Excuse me. So with this structural story, you can then be comfortable to be that, okay, can I invest in this sector, or like, can I not invest in this sector? Paracetamol, we know in COVID, every household had at least one strip of paracetamol in their home. What I think, with 1,60,000 paracetamol consumption in India, I feel if you take what is the PAP consumption, it will be like 50% of paracetamol. 500 grams is minimum needed PAP for one kg of paracetamol. So the half of the market will be like 60,000. In this 60,000, China was more dependent. We were like more dependent on China. So now you have an Indian person who's able to produce this, and PLI is benefit. This can be another structural story for next 10 years or 15 years. Yes, now you have a game to look at it. So that's how I look at every sector,
But I guess,
then management, then
Koushik,
what
like
comes the
we
price.
take a investment horizon of say 3 to 5 years, right? Because beyond that, the guidance which the management
Yes,
gives, we cannot guess it with certainty, right? So you talked about PCM, which is a commodity in
yes,
itself, right? So these commodities are, I mean,
yes.
anybody, there are no, what we say, hindrances. Anybody can enter that and scale that.
Uh,
So basically, the
so
cyclicality
I'm not
cyclicality in
looking at.
business is there. So how to deal with that? Anna?
Okay, so I'm not looking at product level. Is this product a cyclical product or a structural product? What I'm talking about is that, is this industry going to be cyclical or structural? So for me, it is like in next 10 years, this industry sales will happen. That means for me, it is structural. In that, management is giving you guidance for 1 year or 2 years or 3 years, for next 2 3 years, like the company, like whatever you can do it like this. Take a company, plot for last 10 years what are the management guidance was given, and what is the sales that they achieved, and what is the profits that they achieved, what the cash flows they achieved. Just plot this data, and you will see a trend. Every time management is giving a guidance lower than, and you are achieving greater, that means that you can actually trust on the future guidance what management is giving. And if you want to be safer, you just take 20% or 30% lower than the guidance what management is giving. So you can, with that lower guidance, you management has given 100 crores ka top line, and you are taking 70 crores can be achieved for the management in this year. So 70 crores around, you think that around 10% is the profit margin, where 7 crores will be the PAT. With 7 crores PAT, what is forward looking EPS looks like for you? Forward looking PE looks like. If it is under your favorable, it's like 20 or like 30, then go and be invested in that place. Structural trend for the sector. In this kind of situations, what happens, the entire sector of the PE will be, what will be there for the in PEs in this sector companies will be higher, very high. When you know that structural trend in the sector, that means the PEs will not automatically will be high. If the companies are making profits, that means again PE will be very high. Well, I will give another example. Like in the insurance, I spoke about insurance. Like everyone know about PP FinTech, right? Policy Bazaar. Management is guiding for next 3 years. They will make around 100 crores of bottom line. That to PAT. You know what is the market cap currently? Currently, market cap is around 30,000 crores. Let's assume PAT, the company will achieve 100 crores. 30,000 divided by 100 is what? 300 PE will be paying for this management. When you look at this number, right, it is like crazy valuations are given to this kind of companies. According to me, business is great, everything is doing favorable, but still the price will not appreciate. As per, you cannot make money in this kind of investments, because it is actually priced at a very high valuations. And same example you can take in IT sector. 2002, our Infosys. Next 10 years, we were not able to make any money in Infosys. Around 2012 and 2013, people started making money in Infosys. They were able to break even whatever that in they invested in. It's just because the valuations were given for next 100 years or 200 years. If that kind of things are happening, just ignore them. Don't at all go to that places.
Right. So few you already talked about. Let's tell our attendees what how we can identify the financial shenanigans. Maybe two, three which are easy to identify before digging into deeper of the accounts or maybe the financials. So yeah.
So you are telling me like to give any one example for financial shenanigans?
No, no.
Like to
Example you can cite the ones which you already covered. Apart from that, any other pointers which you want to tell attendees on the basis of which they can identify the red flags in the companies.
sorry, I lost your connection. Sorry. Yes, go ahead.
So how we can identify the financial shenanigans in the companies? Few you already
Yes.
talked about. Any other which you would like to tell us?
Okay. So corporate announcement is a big financial shenanigans ratio. Like let me put an example over here. In 2020-22, this year in 6-7 months back, I think there was a company in agro company. Uh, the PAT the company was making around 60 crores, and they're paying a political party with I think around 40 crores are being paid to political party. A clear cut red flag. Why this company need to pay 40 crores as a donation for a political party? You can just be far from that companies. Another way where you can find any companies doing any kind of anky panky in their numbers, just look at uh, uh, the company that again I wanted to take care. I've written an article about it. Somaya Industries. Their cash flows were like beautiful. Companies' return ratios were beautiful. Everything was beautiful. But majority their cash flows was by controlled by only one number. They were not paying their payables. So they were actually not paying their payables, and that cash was kept in the company, and that was converted into the profits. So now you see that. Let me make it very simplified manner. If payable numbers, the company's payable is somewhere around 100 crores and your net profit is 100 crores, that means that with the profit, whatever you made in this company, right, it's actually by not paying someone. That's all. That is your profit. In that kind of companies, be very careful. Or like in receivables, like your profit is 100 crores and receivables is 100 crores. That means that your profit is just made by your profit is made, but that is not converted into cash because there is a receivable person that you need to pay. You need to get your money. So again, be far from this kind of company. So payables, receivables, look at is it equivalent to net profits? Then look at what's the rationale and what is it payment terms and all very good or not? Then talk to the industry people who are working in that sector, and then understand what is happening, and you take your own call over there.
So, Kaushik, there are some accounting practices which we call aggressive accounting, which are by law fine, but again, from investors' point of view, they could be red flags. So, any such examples in mind?
Yes, around depreciation, you can look at them. Majority in depreciation, what happens? This deferred tax or like cash, whatever I was talking about. These are this 70% what I was telling or 60% you have to be greater. The remaining 40% or 30% is actually given for depreciation asset. This accounting difference between the Companies Act and the management what they need to follow. This kind of small issues, that aggressive accounting or conservative accounting, that doesn't matter a lot till the time that you it is actually the numbers are in your favorable, you actually can value them. For example, biggest red flag that you can find, if there is any company, if any company going and writing off their asset, right, just go and ask them the questions, why are you writing off? Let me give one certain example over here. Everyone know about a cement. I'm not remembering the cement company. This there is a like one company, cement company, and another company is an demand. This cement company is making free cash flows negative, and demand is also making free cash flows negative. Free cash flows negative. Why free cash flows will become negative? When their investments is greater than the cash flow from operations. This is very simple. They are investing greater money in the assets. So every time they are buying an asset, and that is converted into sales. If that asset is only been written off, right, then ask the question for the management. Or also you can do another way for understanding the company, is better to go and see. their term sheets. Like you'll get it in the annual reports. Like what are they actually paying for their payables, or like what is their term sheets, or what are their debt numbers. If you can see that cash flow from operations being greater than, like interest expense is greater than 3 times of cash flow from operations, right? That is a good number. If it is below 3, then you be scared. Within 3 years, your interest expense can be retained only by 3 years of your cash flows. There you can get into debt trap also. So look at you have to connect. It's financial shenanigans is nothing but numerator and denominator. That's all. You have to match LHS is into RHS or numerator into denominator. You can take any number in any side, put them there, and understand what is the rationale behind them. That's how you can do the things. And look at auditors. Very big thing is that I know a company whose auditor who was doing audit for a large cap company and a small cap mid cap company, not a small cap. It's around 12,000 crores. Some other company, 12,000 crores company is actually paying auditor fee greater than the large cap company. If this is happening, then why that large cap company is not paying so much and this company is paying more? Then again, that is again another red flag for you to be very cautious.
Right, Kaushik. So, Kaushik, we talked about Capex. So, in Capex, it could be a maintenance
Yes.
Capex, it could be capacity extension, right? So, how exactly we should read it?
Yes.
And if you have read the book Capital Returns, we see that the years following the Capex, 2 3 years are depressed on earnings because there are too much of investments being made there.
Capex depreciation is
Right,
coming
right.
in
So your view
increases.
on that front.
So like okay, capex. If what is maintenance capex? Nothing but depreciation expense. Whatever you're doing it in a company, right? Again, you cannot tell by just looking at numbers. You cannot tell this is a maintenance capex. This is asset capex, or like this is capex for growth. Growth capex and maintenance capex only can be divided by looking at the depreciation number. Look at what is the depreciation in the company, add up the last 10 years depreciation, and in every 10 years if you see that same depreciation ka money ka 1.2 or like 80% or even like 50% is money is only put in investments, that means that is a capex for maintenance. You can only do this for like cumulative number. You cannot do it for individual years. But if you see that capex is going greater than 1.5 as its depreciation, and company will actually tell in its annual report or somewhere or the other place that they are actually going to buy some asset, or they're putting the some asset into place, and that will be like giving something a growth this one. That means that that is only the growth capex. So look at just calculate growth capex for last 10 years and look at what asset turns from that. This ratio you can call is return on invested capital. The growth capex comes from invested capital. What is the returns that you're making from the incremental putting your money over there? So you'll see like last year sales was for last year asset, but this year sales is actually next 2 years ka sales is going to come from the current money that I'm going to invest. That is called return on invested capital. You can see return on invested capital, and if you can do this for individual project level basis, right? That's still again fantastic. Your analysis for that company will be more greater, and your understanding will be more greater if you can do that. That's how I segregate my growth capex and maintenance capex.
Right, right. So, our attendees, if you have any questions, you can send in a speaker request. I'll approve, and you can ask your questions with Kaushik. And in the meantime, I keep on asking. So Kaushik, like how you read the change in management or such changes in the company, and there are times when a person is getting old, and maybe there has to be some person taking over. So, how you read those situations?
So if it is like Crompton waves, you might be knowing like last 4 5 years, I'm not remembering exact year. The management, top level management changed. Once the management changed, right, the valuations entirely went shoot up. Why this happened? Because the good management came into the business. How can you tell that is a good management? Look at what past business they were doing, where they were successful. Every time management can be judged by his past. There is nothing that you can look at future for the management. So in the past, his success ratio with his failure ratio is very high. that means he's good management. And if his failure ratio also, without any scams, he's like doing everything right. Let me give example here again. Wonderla was doing everything right. Management is fantastic, great corporate governance, everything is right, perfect. But there were so many industry triggers came into this one. One was like service tax came into existence. Again, after that, GST came in, demand came in, COVID came in. After that, we have second wave of COVID. So many problems came into Wonderla's or balance sheet. But still, management was doing everything right. He tried a lot of things for himself. But still, things didn't work out and the didn't perform. Yes, it can happen, but the management is still good. If that kind of management is coming into new business and they are like trying to convert this entire non-profit organization into profitable organization, you can look into that company. So I take management, and if you tell about second gen, yes, I would love to see a second gen management in the business, but the problems will start in third gen. Majority of the cases, if you see like problems or like whatever the things are, returns and everything is was wiped off, is only from the third gen management, more than the second gen management. Second gen management is actually try to grow the business. First gen management try to set up the business. Second one will grow the business. Third one will destroy the business. So if it is second gen and if it's the skin in the game is very high and promoter pledge is very low, I would take a chance over there and look at the management. And I would actually go and talk to the management. You have to go and talk to the management. If you can't spoil your legs, if you can't dirty your legs, that means that you cannot invest in the company at all.
Right, fair enough, Kaushik. So, Kaushik, like one, two sectors you already talked about. So, which sectors you see money can be made, and any mega trends apart from insurance you just talked, you see?
I'm looking at PLI. The PLI, wherever the PLI is coming, right? I'm looking that as a mega trend because whatever the PLI was currently announced, they're actually uh, current sales of the companies. If you see at the PLI for entire consumer durable sector, or if you look at the PLI for the pharma sector on the manufacturing side, I think the entire manufacturing boom will start happening in India. That's the space that we need to be invested in. So big trends, mega trends is in manufacturing, and manufacturing can actually current capex and all the management are committed to their for getting the PLI incentives are very very huge, and with it's very simple. The commitment, whatever the PLI, what they're going to get right, it will actually create an operating leverage for a company. And operating leverage will lead to a net profits level go to be in a very major big trend. So PLI is only 6% on your operational profit. Like it can be on gross profits or it can be on EBITDA profit. But when it comes to net profit level, right, it will be like 10% growth. So what happens? Your fixed cost being the fixed cost, that will not grow. Only the variable cost will grow, and you are getting 6% incentive that will flow directly to your profits, and your profit grows very fast. So what I think, PLI is going to be a big trend, and I would love to be invested there.
Great, fine enough. So Kaushik, before we come to an end to this session, any good literature which you advise to our attendees, which can help them in their investing thought process, or maybe understanding the mistakes which big investors of the past did, and they mentioned the same in the books?
Like I love a great gentleman called Michael Mobson. Every year he writes a paper. So with Morgan Stanley, he writes with Morgan Stanley. Now currently there are like lot of around 20-26 papers that he have written. If you read each and every paper, right, every different time he takes a different topic and he try to go deeper of it. So that's the I think that papers are like god for everyone in investing. And second one, what I do love to recommend everyone is like Ashwatthamaran books. That's another gold mine that you can go and hunt, and his classes are free on YouTube. So there's nothing that you need to pay. You just need to give time for it and you have to learn it. So that's where you again you'll learn a lot of things. If you wanted to learn how numbers are flowing from one account to another account, or like how they're tallied, just read how to read financial reports. The author name is from John. I'm not remembering his second name. This again another fantastic book. So these three places can actually make you understand a lot of things. And for the sector side, read the sector oriented books. don't read Gyanbazi books. Like they are like just stupidity. What I feel, try to read the sector-oriented books, or start reading, initiating coverage reports on that kind of companies or like that sectors. That will help you to a lot to understand in investing.
Right. So, Kaushik, I would request the two, three names which you took, kindly write a thread on this, or maybe simply tag
Sure,
me.
sure,
Some of our speakers are asking about it.
sure,
So,
sure,
so,
sure. I would do that.
so, yeah. So, risk we already discussed, but if I were to ask you how exactly you define risk, what is risk in your opinion?
For me, it's very, very clear. Risks in earnings is the major risk, and the volatility in price is nothing, nothing over there. And if the volatility in earnings is very high and it is an uptrend volatility, right, that is not a risk. If it is in a downtrend or an average trend, then it is a risk.
Right, fair enough. So, any concluding remark before we end today's session, and if you would like to tell what you feel about the spaces which I conduct. So, yeah, over to you, Kaushik.
Uh, I'm to be very honest, Prince. I just saw one of your interviews, and then I like the way things are going on. That's how we thought. Then again, our friendship developed, and then I was happy to do this section, and happy to see this kind of learnings, and I would be part of this learnings every day now. Thanks for being inviting me also, and I learned a lot, to be honest. And a lot of people have commented on a lot of things. Now I'll start answering them also.
Great, great. So, guys, the session for today will be closing soon because many people must be waiting for the party thing. And I wish you a very happy new year in advance, and make it good for you and your family. Focus on your health and happiness. Everything else will follow if these two things are in place.
Uh, I would just
And
want to tell,
humble
add more
because
something over
that
here. Happy New Year, my friends. Happy New Year, friends. And congrats, Prince, for reaching 11,000 subscribers on increasing your community in Twitter.
Yeah, thank you, Kaushik. So basically, this is for our attendees who are regular. They already know, and those who are connected today, please check out the YouTube link which I have pinned over the spaces. All the podcasts I do with our guest, I place it over the YouTube channel so that those who miss it can revisit at any point in time. And this year has been really great. I had some 60, 70 odd podcast, maybe more than that. And there are many great guests or stalwarts, you can say, with whom I got a chance. And luckily there were few for which the maiden spaces, I got the honor to basically host them. And with this, I thank you all with the bottom of my heart that you guys have been so considerate in attending our spaces and giving the love and appreciation for our work. So really great. And trust me, guys, today's session is really great. What a great day to end with. And Kaushik, you can check out the handle of Kaushik, and you can also get in touch with the I mean, for any queries or anything, he is available. You can DM him also, and do follow his handle so that all the learnings which he shares would reach to every one of you. So I see many familiar faces, and thank you so much, Vajpayee ji, for being a consistent co-host with me all the time. And he's gentleman. He shares his knowledge, and at times, like we from the start to the end of the session, at times he doesn't get time to interact with others. But again, thank you so much for his patience and consistency. He has been doing great work with his pivots levels which he share over his handle. I would also request our attendees to check out his handle and basically learn the nuances which he shares. So any closing remark, Vajpayee ji, before we close today?
थैंक यू प्रिंस जी। तो बस देखिए, बड़ा अच्छे तरीके से आपने बिल्कुल एंड ऑफ द ईयर में एक सेशन किया है नॉलेज के पर्पज से। तो मैं समझता हूँ जो भी लोग मार्केट में आते हैं, इन्वेस्ट करते हैं, तो ये सब चीजें जो बताई जा रही हैं, इनको अगर थोड़ा थोड़ा भी समझते रहेंगे ना, तो उनकी फिर मार्केट की जर्नी बड़ी अच्छी हो जाएगी। और जर्नी अच्छी हो जाए, इसी के लिए आप भी प्रयास करते हैं, मैं भी प्रयास करता हूँ। तो फंडामेंटल्स को या टेक्निकल्स को, दोनों को मिला करके अगर हम आगे बढ़ते रहेंगे तो हमारा नया साल और अच्छी तरह से बीतेगा। तो मैं सभी लोगों को नए साल की शुभकामनाएं देता हूँ, और उम्मीद करता हूँ कि आने वाले साल में उन लोगों की प्रॉस्पेरिटी, ग्रोथ और बढ़नी चाहिए। और जिस प्रकार से हम लोगों ने इस साल में कंटिन्यूअस एफर्ट्स किए हैं, आपने तो खैर बहुत ही ज्यादा, आपने काफी डिस्गाइज में, जो कहना चाहिए छिपे हुए जो जेम्स थे, उनको ढूंढ ढूंढ के आपने स्पीसेस कराए, और अलग अलग व्यक्ति ने अलग अलग तरीके से गाइड करने का प्रयास किया है। तो ये बहुत ही एक, मतलब इसको कहना चाहिए बहुत ही पुण्य कार्य है। लेकिन अब इसको हम जो लोग सुन रहे हैं, वो कितना उसको इम्प्लीमेंट करते हैं, उसका जो फीडबैक थोड़ा वो देते रहेंगे, तो हम लोगों का इंकरेजमेंट और बढ़ता रहेगा। और धन्यवाद, आपने आज अंतिम दिन इतना अच्छा स्पेस किया, उसके लिए
Thank you,
थैंक यू।
sir, and thank you for Kaushik. Also, he shared great insight today. I can reckon with his learnings, and I hope I did justice to his time with our questions. And with this, I once again make a request to our attendees, since it's last day for this year, and I hope this year went great for everybody. So take our learnings or maybe the spaces as a starting point, and on the basis of which you can start your studies or maybe learnings. In between, Kaushik, I think we have one speaker for you. So, Ravindra, any questions you have for Kaushik or?
Yeah, while he was talking about employee costs, I was trying to find that particular aspect, like per employee cost in balance sheet of a couple of companies. I was unable to locate. So, how do we get access to that relevant source? It's a very good insight per employee cost for comparison in a sector to find out which companies' cost margins are higher and lower. So on basis of that, we can probably filter out stocks. For instance, I have seen percentage in balance sheets, wherein Tech Mahindra, I've just compared three stocks. Okay, I'm just naming it for my study, which I just did while he was talking. So I compared Infosys, TCS, and TechM. So the employee costs on TechM were quite low. So on basis of this, when I'm selecting with these three, I'll go in for TechM, but the absolute numbers may give a different story altogether. So wanted to know where can I get the absolute numbers. If he can help me with that, that would be great. Thank you for
Sure, sure.
giving the opportunity.
Uh,
Yeah, Kaushik,
Sure.
thanks.
Ravinder, what you have to do is that the first thing in whenever you're calculating an employee cost, right, average employee cost, you have to remove auditor's fee, you have to remove top level management fee, key managerial persons fee, and also you have to try to see how many number of employees. For example, like if you go for Kotak Bank, you'll see that number of employees number will be given, and you'll see in expenses you will see that what is the employee cost. Just remove number of employees may you just remove that 10 or 15 people who are in top level, and in the employee cost you remove the management employees, top level management expenses, then you calculate the average cost for the entire for that entire company. That's where you will be able to compare for our A to A. Like now you can compare it with Infosys, Tech Mahindra, and also like Wipro. And
So
like you have to be very sure that uh, you if it is if someone, like if you are only an engineer, a tech engineer, and you just passed out of a college, what is the cost that you would expect the company need to pay for you? You would at least minimum expect a salary of 3.5 lakh, right? At a starting, you basically started in your career, and
yeah, that's
that
true.
number of people will be very high, right? So your average number will actually fall to the near to 3.5, or it will be greater than 3.5. It will never be below 3.5 lakh. It will be greater than 3.5 lakh. And you see that the new employees coming in, like TCS employs a lot of people, right? Or Infosys employs a lot of people. Like in Mysore, if you see, a lot of people come for training in Mysore. So what is their average cost? Like my sister is only working in IT. So what is her average cost? Like by this now, like you'll understand that is it actually they're paying money, or like average cost is actually talking to you? Yes, then it makes sense. So then you will
Okay.
understand that is it able to be compared or not.
Okay. So one question. So one disclaimer: I'm from an IT sector working for past 12 years.
Hmm.
And right now I'm also participating in hiring in my firm, so I have an insight on salaries, how they have grown over years. So that's okay. Since you said the process, I wanted to know whether it's a bottoms up process, meaning I need to pick a company, do that statistical analysis, come up with the final number, not the top down approach, correct? Like I choose
Yes,
a
it's a
sector
bottom up
and
approach.
then pick
Yes.
my company.
Yes, yes.
Okay.
You have to take a company, then do it, and then look at the other companies. You cannot do for like entire sector and then compare it. No, that doesn't work like that.
Okay. 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 So meaning I need to pick up a sector, then find my probable things based on certain other filters, then
Yes,
come down to the employee cost.
yes, yes. Employee will not be a first action, but employee
Okay.
can act if by just doing this work, right? Sometimes you will find this kind of idiotic company which came into an IPO. You know that company has lost around 65% of its from the day it
No,
got
you
listed.
have given no, no. You have given too many red flags. It we can rather. It's like giving a straightforward answer rather than giving too many hints. We got it. Yeah.
Yes, yes.
So the moment you said average salaries are pretty low, they just hire some salespeople in name of engineers. To be
Yes,
honest.
yes, yes, yes,
Yeah.
yes,
So
yes.
it's like in running a call center in name of BPO or rather
Perfect.
BPO.
But the business, what they tell, it is like more than a BPO business.
Yeah, yeah. Probably, the employee costs have two parts. One is the incentive, and other one is fixed component. So the incentive
So
goes
that will also be that
outside
will
of.
that no, that will also be given, right? It is an expense for a company. It will be entered in employee cost only. So when you go for a schedule of employee cost in the annual report, right, you'll actually able to see that how many number of employees are there, what is their employee cost, and how many are like contract employees. So normally contract employees in IT sector will be paid less than the employee of a own company, right? So if you are like Ravinder, you might be doing work in TCS. If I assume you're working at TCS. TCS, if you're a direct employee of TCS, you might be paid around 25 lakhs. But in same work and the same person who's coming through a contractor will be paid around 20 lakhs. But still, the cost of the company will be like on an average basis, it should be something like similar, right? Between you both, it's like around what 22.5 will be the average. It have to come to average. Average will never lie.
Yeah, that's true. That's true. But you rightly pointed out, if number of contractors are more, the other thing is liability gets reduced because the company
Yes.
don't contribute to PF, they don't contribute to gratuity
Perfect.
when
Perfect.
it comes to a contractor employee. So the long term
Perfect.
costs are reduced out there.
Yes.
So
Yes.
yeah.
Yes.
But
Yes.
however, that is a red flag for me because the contractors are usually short tenured and thereby
Yes.
company is not investing on them for a longer term. So
Yes, what happens in contractors, right? The training cost will be very high. So short term में बड़ा effect ले रहे, but long term में वो beneficial नहीं होगा. Like having a permanent employee, long term it benefits to you. Short term you are not benefiting about.
correct. The training costs are high for permanent employee, but
Yes,
contractors they don't incur training costs because they try to hire
yes,
a trained employee for that
yes,
particular
yes.
work.
Perfect, perfect. You are right.
Okay, okay, yeah,
Thank you,
got it.
Ravi.
Yeah,
Any
thank you.
other thing you have to add, or
No, I got my insight, but there was something on another aspect, but I'll rest it for another day. Thanks, Prince.
no, no, go ahead, yeah. Feel free. Feel free.
No, no, I'm just processing whatever I got now, so I'll need to get ahead of this one first. Yeah.
Oh, okay, okay. Then keep
So
it for
if
next.
it is very interesting, right, in employee cost, I'll write it thread on this. Then
Yeah, Kaushik.
I'll
If
give
you,
at
it
least
would be great
15,
if you
20
give an
companies with
example.
examples. Yes, I'll do
Yeah,
that. I'll
one
do that.
example of meaning you can mask the company or probably pick up the same one, the one which is known for giving investor the right value with the buybacks. So that would be great.
I got it. I got your point.
So,
I'll do that.
Kaushik,
I'll do
like
that.
one, one thread
Yes.
on this. One is on that capex to asset turn thing and the books. So, three threads you owe to this spaces, and please mention me so that I can circulate with my circle also. So, we also
Sure,
have
sure, sure.
Ketan with us. So, Ketan, you can unmute and quickly ask your question.
Thanks, Prince Bhai and Vajpayee ji, for allowing me to ask the question. Kaushik Bhai, my question was the red flag one you shared was on internal moving of funds. So
Yes.
the thing is ki if the funds are moved to the promoter in any ways, that has been easily read in the annual report. But when the funds are being routed to other things, so how
Hmm.
what are the key points what you check to identify the movement of funds apart from the promoter? Because
Got it, sir.
most of the points what you covered now, all I see. Apart from that, I also see before concluding my question. I'm adding few more things. One thing what I see, correct me if I'm wrong, number of debtors day that
Hmm.
I most of the time, apart from the receivables and payables, I also see data number of debtors day. And second thing is the inventory. Most of the promoters companies, they adjust their profits showing inventory plus minus, they adjust that also. So these two things I would like to add here in red flag.
Uh, Sir, you're very right. I would take the second question, sir. I'll clarify what I do. I don't see days. Sir, days can be manipulated. Let me be very, very clear. Days can be literally manipulated. So, what I see, if receivables as a percentage of total sales, if it is very high number, right, to north of very, very high number, that means you are actually getting into an problems. And if that receivables number is equivalent or it is like 3 4 times of net profits, right, that matlab you didn't make any profits, sir. Your whatever the profits you are showing in the net profit, right, is actually zero, or you are making losses. It's just that your numbers in accounting terms it is making profit. In cash flow terms, you are not making money at all. Again, when you look at payables side, I look payables as a percentage of 100 percentage of COGS, cost of goods sold. If that is very very high, right, again I am like striking off my numbers, because I'm not paying my payables people. I'm actually killing my payables, because if I kill today my payables, right, tomorrow he'll not supply me the raw material at what prices are there, and he will price me higher quotations. He'll not give me at lower quotations, because he's taking risk, right? That is his sales. For him it is sales, for me it is payables, right? So again you have to look at that number. If it's very very high, right, you be very very careful. And if that is like 3 4 times of your net profits, right, that means that you are actually making profit just by killing your payables. That is not the way that the business should be done. And in inventories, if inventories from accounting terms, like Mahindra and Mahindra, like Mahindra Holidays I'm talking about, this suddenly there was a new accounting rule, contractual accounting rule. Before, the sales were like on long term contracts, the sales were recognized on a different way. And in 2019 the new accounting format came, and they just entirely changed their entire accounting format, that all cost was incurred in inventories. So if you find inventories as a percentage of sales and as a percentage of COGS, if you see this number also very big number, right? If it is that is big percentage business stuck over here, then again, sir, you be very careful. Working capital, these three line items should not at all be very, very dependent on sales, on net profit, on COGS. If this are happening, then you are taking more risk. If you are taking more risk, then ask for good valuations to be entered into that company. Like, you make sure that your valuation will be in your favor if you're taking risk on this three side. If you're not taking risk on your first side, then the valuations will be on favor for the company. You'll actually buy it at a higher premium valuations. So that, I think that answered your this one second question. But let me come back to your first question, sir. Like, can you please tell me your first question again? I'm sorry.
Yeah, the first question was the red flag what you identified, moving of funds within
Yes.
so promoter funds, the moving of funds to promoter, it is clearly seen in the annual report. But moving of
So,
funds through
for
other means,
outside.
so
Yes, yes, sir.
outside. So
I'll give you
how you
example.
identify that?
I'll give you example, sir. I'll take an example. We everyone know recently a footwear company. I'm just forgetting the product of their company. Like, the brand is Red Tape. Mirza International. Sir, you know Mirza International. Like, I'm taking complete name of the company. I'm giving it to you. Mirza International sales were every time happening from Mirza International UK. The Red Tape, the brand title, was owned by Mirza UK, and Mirza International, in Indian company, is producing shoes, and they were owning it with them. Whenever there is an order for Mirza UK, for buying the shoes. The Mirza UK gives supplies that order to Mirza International, and Mirza International used to send the product to you or me if we are buying it. So what happens? The profits were actually made for Mirza UK. That was 100% owned by the promoters. And simultaneously, the UK, what Mirza UK, what Mirza International UK was actually making all the profits, and Mirza International Indian company was making peanut money. And also in the raw material side, you can see the raw materials were bought from it's the company name starts from R. I'm not remembering the complete name. This company was again owned by the promoters, and promoters used to sell the raw material to Mirza International at a higher prices. So you can see that on the selling side also they are taking the profits. On the raw material side also they are taking the profits. So management is actually taking every profit from the minority shareholder or the Mirza International perspective. They're making it for themselves. So in this kind of company, be very careful. Now, why the stock actually rallied a lot? It's very simple. Now, when they started telling that they are going to demerge their Mirza UK, and they're like separating their red tape from their entire business. So because of this reason, the stock start re-rating up, because that's whatever they were doing in the past, right? That was well taken care. And again, in Mirza International, look at this, sir. Mirza International has taken some debt with a bank guarantee. So there will be promoter have to sign a document, like you have to give a surety sign. Okay, because of that signing that surety sign, right? Everyone top level management is are paid every year around 1 to 2 crores every year. So they just signed for 1 year for giving a guarantee surety level. But the payment from Mirza International has been taken by them every year. They used to like charge the company around 1 year, 2 year just on this namesake, telling that I've given a guarantee signed to you. And let me give another example. It's called Acresil. Acresil management, they produce what? Koushik, right? Koushik का Kouch, ये तो मट्टी होती है सर, ये गुजरात में मिलती है. Pehle, this was been imported from some other place. I'm not from some other country. The cost was very high. Suddenly, the management found in Gujarat or Rajasthan, they were finding this raw material. So what did the management did? Management did another personal own 100% owned subsidiary. Sorry, 100% owned personal company banaya management ne, and he bought that matti for 1 rupee, and he started selling at 40 rupees. Previously, that matti was bought by the main company from international worth 70 rupees. Now management is making money over. He's charging the Acresil 40 rupees, but still he left that. No, वो तो पूरा कंपनी को स्टार्ट किया. पहले अक्रेसिल वाज डूइंग पट्टीज, यू नो, दिस कार के ऊपर विल बी ब्लैक कलर लाइन, वो बनाते थे फॉर मारुति सुजुकी. उधर से दे स्टार्टेड इनटू इटालियन दिस वन, एंड देन दे केम इनटू कॉटशिंक्स. और कॉटशिंक्स बनाने के लिए जो मट्टी मिलती है उसको 40 रुपीज में सेल करने. हियर मैनेजमेंट इज स्टीलिंग इन फ्रंट ऑफ यू, बट स्टिल ही इज गिविंग इज्जत टू द माइनॉरिटी शेयर होल्डर, right? Then you can be invested. If there is no izzat for a minority shareholder, then you be very careful to be invested in that place, sir.
Great, great.
Kaushik, it was a great insight. I talking to you parallelly. I was checking these companies, and what you said about the first company, I found out on their annual report. So thanks a lot.
Thanks, sir. Thanks, sir.
Thank you for your question, Ketan. And guys, I have been getting numerous requests on the recording of the session. I don't know those who are connecting for the first time, they might not be aware, but all our sessions are recorded and I place them over my YouTube channel by the name of Accidental Investor. And like, share, and subscribe the channel so that a good basically the I'm proud to say this, the gold mine information you will get on the 59 videos uploaded so far. Whatever your taste is, whatever sector you want to cover, whatever cyclical or structural story you want to cover, you will find over that. Let me bet you, even pharma space, diagnostic, hospitals, whatnot, everything have been covered by our stalwart or expert guest, and we place all the videos over there. So I humbly request you guys to check out and please spread a word so that the good information may reach more people. And we have another speaker with us. So he got dropped. Okay. Super gaming. Yeah. Super gaming. You can unmute and ask. And guys, let me make sure we will close the session by 7, latest by 7. We cannot extend beyond 7, right? So if you have any questions or if you want to interact, kindly send in a speaker request in last 20 minutes. Yeah, Super Gaming, unmute and ask. Super Gaming, you are still on mute. You have any questions or you sent in and by mistake? Okay, anyway, Kaushik, it was really great, and I trust me, our next session would be due, and surely will come with a great set of, I mean, what we say, topic or something interesting to add value to our listeners. And yeah, so very happy New Year to everyone, and I wish you a very good health and a tons of happiness to everyone around, and may you build your wealth, but always make sure when it comes to market, your expectations have to be reasonable. Your character has to be humble, and humility is one thing which can uh, uh, take you through this market, right? All up and downs. So in the meantime, we got another speaker by name of Jay. Jay, you can unmute and ask.
Good evening, Prince. Good evening, Bajpayee ji, Ketan Bhai, Ravindra Bhai, and Kaushik Bhai. And a happy New Year to all. Sir,
Good
I
evening.
had one
Thanks.
question. This has been in my
Yes.
mind for long, and I want to understand this. So you see a lot of companies do a lot of mergers and acquisitions, right? And not all
Hmm.
companies are wrong in doing it, but there are some which can become Valiant Pharma, right? Something like Valiant Pharma.
Yes.
Now, deciphering
Yes.
the intangible assets parts, right, where they basically goodwill, they basically put it in the goodwill when they acquire it. How do you decipher
Hmm.
it that some company is doing this number of acquisitions again and again, and effectively they're increasing the goodwill and they eventually might become a Valiant Pharma? I'll not name a company, but there is an automobile ancillary that does that in India
I
consistently.
I would take the name. Like I'm okay to take the name. We're talking about Mothers and Sumi, right?
Yes.
So, so like to be very honest, I would never look into those kind of businesses at all. I might still make money, but still, I'm scared to look at these businesses.
No, but how do you decipher it? Whether it's a genuine acquisition going on or is it just round tripping of money?
So I would not at all look if it might be a genuine acquisition or like it might be anything, but still I would be not looking at it. I would only look at demergers, but not the acquisitions, because acquisitions might be at a higher valuations, right? But demergers cannot be demergers. If it is demergers happening, that will be in your favor.
No, no, but Kaushik Bhai, the question is then, yeah, these companies, I'm not advocating, let's say
Hmm?
Valiant Pharma became one of the best shots for some of the people. They made billions of money out of that, right? Now, if you can
Yes.
decipher that accurately, you can make a lot of money in the short side of it, things, right? So, how do you,
I agree. I agree with you. Your point, but I don't have that kind of capacity to do it because I don't understand those numbers. Because I cannot value when there is going to a an acquisition is coming up. Only the way that I can value is that if that valuation, I don't know if it is actually if there is an acquisition, if that is literally going to be an favorable for a company, I would only pay price to sales 1 or 2. Maximum is this much. I would not even pay for the assets or I'll not pay for anything. And this price, what I'm talking, the sales, what I'm talking about, it should be a cash sales. I'm not talking about credit sales. I'll just minus credit sales and I'll just do 1.5 or like 1.2 as an into, and I'll be happy to pay for them.
that's interesting. That's
So other
interesting,
side,
Kaushik.
that other side, I will not do at all.
No, Kaushik, but I'll ask a follow up here. You know, most of these acquisitions that
Yes,
happen, right? Let's say I'm a company A is acquiring company B. Most of these company B they have
yes,
order book which are not really materialized,
yes,
and they value those order book, and as a result goes in
yes,
goodwill. That becomes the most tricky part.
yes.
How do you decipher those?
Again, I'll accept over here, but I don't understand those numbers only. If there is an order book, right, what I understand in order book, again, I'll tell you what I was looking at PI Industries. The order book, if that order book is converted into an liability side, that should be like cash is given to the company. Then only I consider that as an order book. Management can tell that, okay, this is the order book that I'm getting. Arey, okay, you are getting on order. Just pay me at least 1 rupee of that order. I will consider that 100 rupees worth of order. It's going to be true for you. I need confirmation. मतलब क्या बोलते हैं वो token money तो चाहिए. Or else like there should be some money to be put it on the table. Again, you have to have it in your balance sheet on the liability side and as an unearned revenue. If it is not there on the liability side, then that is not an order book that the company is actually telling. Yes, might be order book आ सकता है, but still I'm that situation. I can make money or I cannot make money. I can afford to not to look at them. I have a lot of other places to look at the companies, right?
No, I agree, Kaushik. Now, just a follow up. The EV industry.
Yes.
Let's say you talk about Nikola
Yes.
or anybody in the US, right?
Hmm.
Most of their valuations, their
Hmm.
stocks, their earnings projection is on the basis of order book building, right? Yeah.
Order book,
So
yes,
in that
yes,
case, you
yes.
will not touch the EV space.
No, I'll not touch it. To be very honest, I'll not touch it.
Okay, thank you, Kaushik.
I'm okay to, I'm okay to give it up on that side.
Yeah, Kaushik bhai, a follow-up question to Jay.
Yes,
Say many times na, the acquisitions are also made to kill the competition. So
yes,
in that case, one has to see that acquisition part also, na? Because
yes.
if I give, yes,
I got your point, sir. I got your point. तो आपका पोजीशन जो आप बात कर रहे हो ना, इट्स लाइक टू किल द कंपटीशन एंड टू इंक्रीज योर मार्जिन्स. आप किस पे खेल रहे हो? यू आर प्लेइंग ऑन नेट प्रॉफिट्स. रिटर्न ऑन इक्विटी पे तीन चीजें होती है, नेट प्रॉफिट, असेट टर्न्स एंड थर्ड वन इज ऑन फाइनेंशियल लिवरेज. बट फाइनेंशियल लिवरेज आई इग्नोर इट, जीरो, मतलब उसको बा भी नहीं देता हूँ. एंड द सेकंड थिंग व्हाट आई गिव, नेट प्रॉफिट पे ऊपर खेल रहे हो, देन आई वुड लुक एट इट. और यू आर डूइंग एक्विजिशन फॉर योर असेट टर्न्स, दैट्स वेयर आई लुक एट इट. आपका असेट टर्न्स ऊपर हो रही है, then I would look at that acquisition. If you're trying to increase your net profit margins, right, by then acquisition, then I'm not interested to look at it.
no, but Kaushik, by many times what happen is कि company is generating huge cash from its business, and
Yes,
when the competition, I will name with an example, Pidilite.
yes,
Pidilite has done
yes.
in past and it is doing right now also, and even
Huh.
ITC also they have huge cash generation, and what they do is कि when they see a local plant which is growing in good scale, they go and buy out in 5x or 10x of their value. So they
Sir, वो तो
create,
asset acquisition है ना.
yes, 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 yes.
They are trying to do scale up in their model. That's where I would look at. Sir, asset turns के लिए increase करने के लिए और scalability और their entire plant can be made in comfortable manner. I would look at those kind of acquisitions, sir. बट वो मार्जिन सेफ्टी, मतलब देखो सर, दिस इज वेरी सिंपल. इफ यू आर, इट्स कॉल्ड बैकवर्ड इंटीग्रेशन और फॉरवर्ड इंटीग्रेशन. बैकवर्ड इंटीग्रेशन क्या होती है? मार्जिन सेफ्टी के लिए होती है. और फॉरवर्ड इंटीग्रेशन क्या होती है? सेल्स के ऊपर होती है. You're trying to increase your sales. Backward integration is an instant power to you because margins safe हो जाती है आपके पास. You just acquire some raw material person and you start taking the raw material from there. You will save up on the whatever the cost you used to pay. मतलब वो profit जो raw material बना रहता है ना, उसका profit share आप save कर लेते हो. बट सर उससे क्या कर लेंगे आप? बहुत बड़ा तो नहीं बन सकते. बट आपका फेवर पे उस, इफ यू आर गेटिंग दैट काइंड ऑफ कंपनीज एट योर वैल्यूएशंस का मतलब आई नीड टू गेट दैट वैल्यूएशन इन सच ए लेवल दैट वो कंपनी का जो सेल्स होती थी उसका इक्विवेलेंट मुझे चाहिए, मतलब 1 or 2 इक्विवेलेंट पे चाहिए. और एल्स आई विल नॉट लुक एट देम एट ऑल. I would actually neglect them being in my पूरा पूरा बैलेंस शीट का साइज इज 100 crores and if it is only 1 crore, अरे I will not at all put my head on that side. Even it is 5 crores also I will not put my head.
Great, Kaushik. So we take one last question from Rajashekar. Rajashekar, you can unmute and ask your question. Rajashekar, you there? You are still on mute. Any question, or you also sent it by mistake, or what?
Hello.
Yeah, go
Hi,
ahead.
hi, Rajshekar.
Yeah, hi Kaushik and hi team. It's a very good session. Yes, I want to know about recently you have talked regarding insurance sector and compared
Yes.
to US and China, India demat accounts penetration is very low. It will
No,
be I
no,
think
no, no,
five
no.
percent.
Penetration is not at all. Now the penetration between US, China, and India, right? We all three are
Hmm?
equal. like I explained that one in the section. You cannot calculate penetration by just taking the whole Indian economy. You have to take
Okay.
those kind of data. You have to eliminate, for example, like whatever I was telling, 2.5 lakh household income below, right?
Yes,
Those
yes, yes.
population, you have to just ignore them. And if you ignore, there's only 28% of the household people are like eligible for this. In 30 lakh, 28 percentage into 5. This will be the total population that are eligible to get an insurance. And how much is the penetration? Current penetration with that, if you see, we are around 40 percentage penetrations. You have to play with the number. If you are doing that, you can understand what is the penetration of India. So for example, let me put again once again, entire state around. Let's take. I can see you're from Andhra. I can understand that. Like we also spoke in one of the event. I think you attended there, right? It's the same person, right? You are.
Yes, I am same.
Yeah. Okay. So, like, you're from Andhra, then look at Andhra. Like, what is the population of Andhra? What is the average buying price of house buying? What is the average price of house buying in Andhra? And you will see like what is the people like what household income in Andhra. If you do everything statistics right, and then you will be like getting there will be like in distribution, normal distribution, there will be outliers. You have to eliminate outliers in your data and then look at whatever is the distribution. With that distribution, you should look at what is the average numbers that you get it. Is it favorable in your way or it is not favorable in your way? That's where you can invest in them.
Okay. Thank you.
Thanks. Thanks.
So thank you, Rajashekhar, Jay, Ketan, and everybody else who asked the questions. So this came to an end of today's session, and it was once again very thankful to Kaushik for sharing his knowledge. And I agree with the guest. Like there are many ways to make money in the market. You have to identify your niche and keep working on that. The idea of learnings from these spaces is to compound your learnings, and there are times when you get one trigger which you are looking for, and that is very helpful in building a strong framework, investing framework, basically. So with this. I once again thank everyone from the bottom of my heart. And this year has been really, really kind to me. Had some great people over podcast, and trust me, for January and February also, I have 17, 18 people in pipeline, and many others are approaching, and even I am approaching. So this is going to be really interesting. And trust me, the sessions are purely educational. And please take it as a starting point. And if you are liking our work, please, the Sankalp, don't cry, yaar, sending. Okay. So we got one more speaker request. Sankalp, you are speaker. You can ask now.
Hello, Kaushik bhai. I just wanted to ask this. So I'm very new to the financial world and the financial statements wala thing. So how do I actually start to learn about investing and all that? Because right now I know nothing about investing and all of that, like the whole financial space. I'm very new to this. So can you like guide me, like how exactly do I start to know about
Very
this?
simple. It's very simple. Start some business, then you'll understand what and all you need to look at your own business. एक छोटा business पे try करो. If you have any skill, try to monetize that skill. You try to teach one or two people that skill and you ask them money. Then you will actually understand किधर किधर आप गलती हो रहे हो. Or you start a manufacturing company. एक छोटा से कुछ तो बनाओ आपका हाथ पे input पे and exit पे. That one will be with a value added to another person. Just try to sell something or another thing. आप वो करने से ना आपको you'll understand how the business is running. And then you try to read one or two businesses. Business evolutions का books पढ़ो. Business कैसे बनती है, like what and all things are happening in to create a business, that and all you understand. Then you will only make sense. Okay, if you're running business, if this is sales, see for example, you opened a lemonade stand. एक जूस शॉप तो खोल दिया आपने. You are selling 100 cups juice. One cup का 1 रुपी सोच लेते. One cup का 10 rupees सोच लेते. Okay, 10 rupees into 100 is 1000 rupees. Should be your sales. You sold 100 cups. Okay, in that 100 cups, you find that आपका friends आए दुकान पे, like there are like 10-15 people who came to your shop, मतलब you gave all of them, मतलब उन लोग आपको पैसा नहीं दिया, they are telling you like they will pay you tomorrow, and it's what 100 people में 10 people coming and giving you, it's like 100 rupees is gone out of your hand, आपको पैसा नहीं मिला, एंड आपका नेट प्रॉफिट है ना पॉजिटिव लेवल पे दिखेगा, बट कैश फ्लो टर्म्स पे ना आपको नेट प्रॉफिट बहुत नेगेटिव टर्म्स पे दिखेगा, बिकॉज यू वॉट एवर द मनी दैट यू हैव गॉट is actually stuck up with the people who you have to receive. After P&L statement, you made money, but how will you be able to make money? You will only make money in the cash terms. आपका profit margins is only 10%. 10% of 100,000 rupees is what 100 rupees. 100 rupees already आप तो credit पे बेच दिया. आपके पास business में कुछ छोटा ही नहीं ना. You are actually making losses. Got it? तो आपको ये normal business sense लगा के you can understand the business, other businesses. So when you're starting, start with a manufacturing company. That will be very easy. Then go with sectors like service sector. Then you go for another sectors. Like तब जाना banking, insurance, ये सब. तब तक तो manufacturing ही रहना.
Okay, Kaushik bhai. Thank you, bhai.
Thanks.
Thank
I
you,
hope I add
Sankalp.
value for everyone here.
Indeed, you did. And the session will be placed over YouTube, and I'll be sharing link with you as well as other attendees. And those who missed initially can surely refer to that. So with this, I take your leave and enjoy 2000 today's eve and very happy New Year 2023. सबके लिए health wise, wealth wise अच्छा रहे. Be humble, be open to learning, and market is very kind if you are consistent. So over a period of time you will do well. And with this I take your leave. And yeah, don't forget to subscribe the YouTube channel. I am putting in so much of hard work. You can imagine like 2 hours of podcast, and then I edit the videos and I upload it. That is a very cumbersome activity, and I have been doing this consistently. So as a token of respect, you can follow the channel and spread a word. And if you're liking our work, please write to me. Today is last day of 2023. I hope I added some value to everyone around. And with this, your sport is one thing which has kept me motivated. And with this, I take your leave. Good night. Take care. Happy New Year once again.
Happy New Year, friends, and thanks, Prince, for calling me here.